Okay, we will start with question 1. Question 1 asks, question 1A asks, explain with reason the appropriate accounting method for Mercury Berhad to record the investment in Venus Berhad and Mars Berhad. Mercury Berhad has used the consolidation method. The consolidation method is a type of investment accounting used for consolidating the financial statement of the majority ownership of investment. So this method can only be used when the investor possesses effective control of the investee or the subsidiary, which is often but not always. Assume the investor owns at least 50% of the subsidiary share or voting rights. The consolidation method works by reporting the subsidiary balances in a combined statement along with the parent company balance. Hence, a parent company combine its own revenue with 100% of the revenue of the subsidiary. So in this question, Venus and Mars were subsidiary to the Mercury, as Mercury requires 60% and 70% respectively. So Mercury Berhad has control over the Venus and Mars Berhad. So the parent company will report the investment in subsidiary as an asset. So which the subsidiary reporting the equivalent equity owned by the parents as equity on its own accounts. So at the consolidated level, an elimination adjustment must be added so that the consolidated statement is not overstated by the amount of equity held by the parent. So the elimination adjustment is made with the intent of offsetting the intercompany transaction, such that the value are not double counted at the consolidated level. Next, we will move to the question 1B. Question 1B asks, compute the goodwill or the bargain purchase of the acquisition of the Venus and the Mars Berhad.
Move to the question 1B, compute the goodwill or the bargain purchase of the acquisition of the Venus Berhad and Mars Berhad. Goodwill for Venus City, we will get 4.6 million. For NCI, we will times 40% times with the total fair value of the net asset at DOA. For ordinary share, 2 million we will plus with another 400,000 because in additional information number 6, it stated that Venus Berhad declared a bonus issue of 1 ordinary share for every 5 share held out of the general reserve. So we get 2 million times with 1/5. So we will get 400,000. So for general reserve, we will minus 400,000. So we will get 100,000. So for Venus, we will get goodwill 1,406,000. So Venus also have the liability, which is 10% of debt. So City for 10% of debt, which is 1 million. We minus with the controlling control, which is 100%. So we will minus with 1 million. Next, we move to the goodwill of Mars. So City direct for Mars, which is 10 million times with 1.1 ringgit and 20 cents. So we will get 12 million. So for NCI, we will 30% times with the total fair value of the net asset at DOA. So goodwill for Mars, we will get 8,780,000. So Mars also have another share, which is 2% of preference share. City for 2% of preference share, which is 400,000. We will minus with how many Mercury control in Mars. So 1 million, so we time with 40%, so we will minus with 400,000. So for NCI, we'll times with 1 million times with 60%, so we get 600,000. Next, question 1C, compute the non-controlling interest and the group retained profit as at 31st December 2017 using the schedule form. So for Venus, Mars and 2% of preference share, we will get for the previous question. So for her parents group retain group general reserve, which is 4 million. So for the Venus group general reserve, for post we get 500,000. So we minus with pre, which is 100,000. So we get 400,000. So we time how many Mercury control in Venus. So we get for group general reserve 240,000. So for NCI we get 160,000. For group return profit for Venus, return profit at the end, which is 6.3 million. So we minus with return profit at UAH, which is 1.5 million. So we will get 4.8 million. We plus or minus we add any adjustment. So we have under depreciation, which is 300,000. So we get 4.5 million. So we times with 60%. So we will get group retained profit 2.7 million, and for NCI we get 1.8 million. So for retained profit for holding, we have retained profit 60,800,000. So we minus or add any adjustment, which is we have impairment loss, which is 74,000, unrealized profit 500,000, over depreciation 100,000, ordinary income 60,000, ordinary income in March, which is 105,000, that we get in additional information number 8, which is must also declare before the year and a final ordinary dividend of 150,000. Which is 150,000 with times with how many control in March, which is 70%. So we minus with ordinary expenses, which is 200,000. So we get group retained profit for parents, which is 60,291,000. Group retained profit for March, we have retained profit at the end, which is 1 million. We minus with retained profit at DOA, which is 600,000. So we get 400,000, and then adjust any adjustment, which is we have under amortization, unrealized profit of goods, and ordinary expenses. So we times with how many controlling control in March, which is 70%. So we get negative 105,000 for parents and negative 45,000 in NCI. So the total amount we will transfer to the consolidation statement of financial position. Okay, next we move to the question 1D, which is prepare the consolidated statement of the profit or loss of Mercury Berhad for the year ended 2017. So in this statement, we need to adjust any inter-sale or inter-purchase transaction. So we have in additional information number 2 and number 3, we have inter-sale and inter-purchase transaction, which is 50 million and 30 million. So then we need to portion the amount, because Sim Mercury acquired mass on 1st July 2017. So we need to portion the amount of mass by C over 12. So the profit after tax, we will get 10,660,000. So attributable of the profit after tax to NCI, which is profit after tax for the year for Venice is 5 million. So must we need to portion, which is 1 million times with C over 12. So we will get 500,000. So we add all minus any adjustment. So we have unrealized profit, which is 500,000 in March, and then depreciation, which is 300,000 in Venice. So we get profit after tax attributable to parent, which is 8,840,000, and for NCI 1,820,000. Okay, next we move to the question 1E, which is prepare the consolidated statement of the changes in equity of Mercury Berhad for the year ended 2017. So for balance brought down, we get 10,950,000. So for NCI, for balance brought down, we get 2,680,000. From the working, we issue that post retained profit for Venice 1.5 million, with minus with the pre-retained profit. So we times with the how many parents control in Venice, which is 60%. So we get for group retained profit, which is 900,000, for NCI 600,000. So the NCI at DOA for Venice, which is 2,080,000. So the total balance brought down for group retained profit, which is 10,950,000. So for NCI we get 2,680,000. So we plus Mercury have acquisition during the year, which is March. For NCI we have 1,380,000. So dividend paid for group retained profit, we need minus, which is 200,000. For NCI 45,000. So balance carried down, we get for the group retained profit, which is 90,590,000, and for NCI 5,835,000. Okay, next we move to the last question, which is prepare the consolidated statement of financial position of the Mercury Berhad as at 31st December 2017. In this statement, we need to know there is any hidden transaction involved. So in this statement, we have hidden transaction, which is dividend in the scenario number 3, which is only as record the dividend. So we need to set off any intercompany transaction. So in this statement, we do not need to portion the amount of mass, even though Mercury acquire mass on the 1st July 2017. We just take a full amount of the mass, because statement of financial position is as at 31st December. Okay, for the total asset, we will get 63,141,000. For the equity and liability, the total is 40,671,000. Okay, that's all from me. I will pass to Hanis for question number 2. Thank you.
Proceed to question 2. A joint arrangement is an economic arrangement where two or more parties have joint control. Some of the areas covered by the contractual arrangement as follows. Number 1, the activity, duration and reporting obligation of the joint arrangement. Number 2, the appointment of the board of director or equivalent governing body and voting right of the ventures. Number 3, the decision-making process, matters requiring decision by the parties and the required level of support of those matters. Number 4, capital or other contribution by the parties and manner of sharing among the parties of the joint arrangements, asset, liabilities, revenue, expenses, profit or losses. Next, according to MFRS 11 joint arrangement, joint control exists where the parties contractually agree to control and decision about the relevant activities of the joint arrangement have the unanimous consent of all parties sharing control. The parties have to assess the extent to which the parties should act together to direct the activities that significantly affect the return of the joint arrangement. No single party controls the arrangement on its own, but a party to joint control can prevent the other parties from controlling the arrangement. Next, these could be parties that do not have joint control. For example, 4 parties have an interest in joint arrangement. 3 of the 4 parties have joint control and 1 does not. The party does not have joint control is a party that participates in but has no joint control. Next, there are 2 types of joint arrangement, which is joint operation and joint venture. We will proceed to joint operation under right of the asset. The parties to the arrangement share all interests in the asset relating to the arrangement in specified proportion. Ownership interest in the arrangement or in proportion to the activity carried out through the arrangement that is directly attributable to them. And next, for the joint venture, the asset brought into the arrangement or subsequently acquired by the joint arrangement are the arrangement assets. The parties have no interest in the asset of the arrangement. Next, we will proceed with the obligation for the liabilities for the joint operation. The parties to the arrangement share all liabilities, obligation, costs and expenses in a specified proportion. For example, in proportion to the parties' ownership interest in the arrangement or in proportion to the activity carried out through the arrangement that is directly attributable to them. The parties to the arrangement are liable for claims by third party. Next, we go to joint venture and the obligation for the liabilities. The joint arrangement is liable for the debts and obligation of the arrangement. The parties are liable to the arrangement to the extent of their respective investment or their obligation to contribute any unpaid or additional capital or both. Lastly, creditors of the arrangement do not have right of recourse against any party for debts or obligation of the arrangement. That's all for me.
Thank you, Hanis. My name is Farhana and I will proceed with question number 2. A. The relationship between Berhad and Very Berhad before the right issue is Very is subsidiary company to Lily Berhad since the acquired shares was 75%, qualifying Lily as its parent, and after the right issue, the number of shares increased to 1,120,000. Very still maintained as a subsidiary since Lily did not subscribe the issue and sold it to the other parties. Next, we will proceed with the calculation of goodwill. Consideration transfer 1,800,000 plus NCI 400,000 and get 2,200,000. Compare with the fair value of net asset 1,600,000 and goodwill will be 600,000. After that, C. Calculate gain or loss. Proceed receive 3,750,000 plus with a fair value of net asset of its investment at DOA 3,564,000 and get 186,000 plus with the proceed from sale 400,000 and the gain on disposal was 586,000. D. Goodwill in consolidation was 600,000 being 1,800,000. Before the private placement, Lily had a 75% controlling interest in Berry. As a result of the private placement, the number of issued shares would be 1,600,000 with Lily holding 600,000 shares only. Therefore, only the placement Lily's interest dropped to 25%. The entire amount of goodwill consolidation of 600,000 will be written off. Fair value of 600,000 shares in Berry was 4,200,000 minus with the proportionate share of net asset before placement 3,750,000 minus with goodwill 600,000 and get loss of statement of profit or loss 150,000. Based on the amount of share capital, the investee is no longer a subsidiary and should not be consolidated. Assuming the group is able to exercise influence over the investee, then it should be equity accounted and treated as an associate. The parents will consolidate the revenue and expenses of the subsidiary up to the date of the deemed disposal, and subsequent to that date will equity account the performance of the investee. In the consolidated statement of financial position, the investee will not be consolidated, but the investment in associate will be shown as a single item and equity accounted.
Okay, thank you to Farhana. We proceed with question number 4, which is the last one. Question 4, according to MFRS 10, an investor, regardless of the nature of its involvement with an entity, shall determine whether it is parent by assessing whether it controls the investee. An investor controls an investee when it is exposed or has right to variable the returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. The relationship between the investor and investee might change from no relationship to that of a parent and subsidiary, or from associate or joint venture to subsidiary. In this situation, on 1st October 2017, Aisyah is associate to Adam as it acquired 40% of ordinary share for 2,750,000. On the same date, Aisyah acquired 50% of Adam Berhad convertible debenture, but nothing changed since there is no business combination take place. Retained profit on 1st October 2017 is to be used to calculate goodwill. Since there is none of the debenture have been converted by 31st December 2017, there is no increase in interest in Adam Berhad for the year.